Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
Up, people, it's Swizzle here. That's Elizabeth Thomas in the middle. Dan Nathan, you know, from the great hair all the way to the left or the right, depending on your point of view. This is Market Call, 11 a.m. on the East Coast. We have a bunch of new viewers today. I know that for a fact. I'll start with you, Elizabeth. How do you find yourself on this glorious September day?
I'm a little offended you didn't talk about my great hair.
Yeah. I said, hold, stop. So I slow down. Slow your roll there, sister. Because the other day, I actually said, your hair looks fantastic. I said, it's a great ombre thing you got going on. You're like, oh, I didn't know you knew ombre. Blah, blah, blah. We had this conversation. I mean, maybe you forgot.
Right,
Clearly you did.
Your
hair looks fantastic.
That was on the Risk Reversal podcast. You had the head of SoFi's investment strategy on the pod. I listened, by the way. I thought it was excellent.
Fire emoji. No, it's an ombre thing. See the low lights she's got going on? It's nice.
This is a Liz Thomas day in the market.
Why is that?
You get to talk about the stuff that she gets to talk about. She got to listen to this Fed presser yesterday and all the intrigue around the Fed governors and the dot plots and the fact that the market closed dead flat on the day. But Guy, you said this to me in our podcast. You say, you know what? We're likely to have a day tomorrow. You didn't know which direction, but some volatility. It's kind of the way it goes. Liz, give us the 411 on what you heard and then why. How many hours later, market participants are, I don't know, they took a beat and now they're doing some stuff in the markets here. And you know what? The equity market, the bond market are going in different directions here.
Yes. So Guy will shout if I don't say this first.
Please.
What's happening today is curious in markets because we actually have yields on the rise after a Fed rate cut, which is what I would call a relationship problem. But we'll talk about that later. Equities are up, and that's what people usually focus on. Dan, you're correct. Yesterday, we ended the day slightly down in the S&P and the NASDAQ in equities. The Dow was actually up, but I know you don't like talking about the Dow.
We talked about the Dow yesterday, didn't we, Guy? I think we did.
I think a little bit, just a little bit.
But anyway, the Dow was up, but the S&P and the NASDAQ were down. I think what happened yesterday was because it was one of those meetings where they released the new summary of economic projections and the dot plot.
The SEP?
The SEP, yes. I should make sure that everybody watching understands what the SEP is. So they released that, and then there's also a message from Powell, and clearly we have the rate decision. The rate decision itself, no surprise. Let's just forget that even happened because everybody thought that was going to happen. The commentary from Powell continued to be about concerns over the labor market, but that things were still okay. And they were just trying to maintain the strength that the economy had and that they hadn't really ever been in this position before. But here's the issue. And I talked about this in the column I wrote. There was a contradiction between the SEP and the dots. The dots got more dovish, meaning the governors decided that they see more rate cuts both in 2025 through 2026. They see more cuts. But the SEP got stronger. So why in the world would you cut rates more if things were getting better and inflation was going to rise? So I think what happened in the market yesterday was a lot of confusion. Are we happy about this? Are we sad about this? We're going to get more cuts, but the data is going to move in the other direction. So are they doing it wrong? And the main takeaway that I had was that I think there's actually a risk that they cut too fast, too far. Right. And then you stoke inflation. I don't think that risk occurs until 2026, but that's where we are.
All right. So let's go into your note and your slides. Are you a fan of Eagles, Elizabeth?
Eagles as the bird or Eagles?
No. I didn't say the. I said, are you a fan of Eagles?
So yes, that's the bird. Sure.
No, well, band actually. I mean, because it is Eagles. It's not the Eagles. And
I think in that regard, though, Guy, you have
no,
to.
It's not. And I am telling you now.
I listen to rock and roll like royals,
and they screw it up
as the Eagles. I know, but in this instance, it's not particularly clear what you're asking. Do you know what I mean? So if you say the Eagles, we all know that it's the rock band the Eagles. By the way, guys, they're going back to the Sphere.
Yeah, I saw them at the Sphere.
I know. Are you going to go back
Linda
to
Snow?
the Sphere?
You know, we sat on the floor, which makes you get a crick in the neck. You got to sit like
You stood on the floor. See,
Excuse
like
me?
we can't call it the Eagles, but you said we sat on the floor,
we
and
sat
you
on
did
the
not
floor.
sit on
There
the
were
floor.
chairs.
There were not chairs.
Now, first of all, it's Eagles. I mean,
Were there chairs on the floor?
Yeah, there were chairs on the floor. I don't stand at concert. I mean, what am I, 9 years old?
At the Sphere, they did not have seats on the floor. It says a little bit about the demo of Eagles fans that they didn't have chairs on the floor.
Well,
no, they're not. There's the GA pit. You have not been to the Sphere. It's standing on there, even for the Denko standing. It's just Eagles, where the average age is. What are you like?
My age, 61. I'm gonna, if I get to December. Oh, today's September 18th. October, November, December, 3 months. Yeah. Okay. Anyway, fan of Eagles, yes, you are. So they released Hotel California, great album. Although the song Hotel California, not one of my favorites. And Life in the Fast Lane, also on that album, I think is a shitty song. Side 2 is where all the good songs are, and one of their songs is wasted word, wasted time. Well, we're living on, apparently, Elizabeth, borrowed time. So let's go to your note. See what I did there?
So that was okay. But
where can one find your note, Liz?
Hold on, guys.
Where can one find your note?
You're bringing back a note from before. That was the previous note. This note is called Cut Loose.
Oh, I thought this was the borrowed time note. I apologize.
This one is called Cut Loose.
Jeez, Amanda.
I hope that everybody
go to Mario's. Go to Mario's.
Footloose song in their head right now. By the way, my favorite Eagles song is Peaceful, Easy Feeling.
Yes. And do we have one now?
So, okay, this note is called Cut Loose. Now,
Cut Loose.
One of the biggest things that came out of yesterday, in case anybody doesn't know, there's a new Fed governor. His last name is Myron. We learned that that's how you say it yesterday. I'd been calling him the wrong thing for a long time. Myron. It was like Myron. Yeah. Anyway, it's Myron. And there's a dot on the first chart that I have in my note. If we can get that up, the dot plot. The dot plot is what shows us all of the different officials and what they think rates are going to be at the end of this year or the following year. There's a dot that's way out of line on this chart. And that was likely Mr. Myron. We don't ever really get confirmation of whether or not that's the case, but there it is. First of all, my take on this is that was purely a mathematical effort. That was not him actually saying, I think that we should cut 6 times by the end of this year. See that dot all the way down by itself. Okay. That was a mathematical effort to do what happened on the top of this chart where you see the median. The median before was, we have this old chart. The median before was 3.9. Now the median is 3.6. So what does that mean for 2025? For 2025, that means that the Fed said, we thought we were going to cut twice. Now we think we're going to cut 3 times. But really it's skewed by that one lonely dot at the bottom. So what's happening here is a ton of dispersion between Fed members. And dispersion, you've got a bunch of people saying that we're only going to cut once, and then a bunch more people saying that we're going to cut 2-ish times, right? And then somebody way out of whack. What I think is going to happen October and December of this year is that both meetings will end up being live meetings because we're going to get a lot more data in between now and the end of October, but the market is probably also going to move around. And when I say live meetings, it's that we came into this meeting with a 100% chance basically of a 25 basis point cut. We could have lower chances as we get further along this year, also because we have dissenters and that doesn't happen all the time. So having dissenters, which means voters that are against what the actual move was, I think the number of dissenters grows as we get further along. So this is an important thing to watch. And I think it's another reason why the market ended the day confused yesterday. It doesn't seem so confused today, but it was confused yesterday.
All right. So the S&P might not seem confused, but you led this by saying the bond market appears to be, and you have a sell-off in the TLT. I think you probably have it in front of you, but I think 10-year yields are back above 4.10, maybe approaching 4.11 or so, which is somewhat counterintuitive, but it's pretty much what we saw back in September of last year. Now, one day does not a trend make, but I would submit this might be the beginning of the bond sell-off that I've been waiting for. So thoughts on that?
So what I've thought for most of these past couple months is that you see the 2-year Treasury tracking what Fed expectations are. So what people expect the Fed to do with rates. The 10-year Treasury has tracked inflation expectations or even inflation fears. what I talked about before with the SEP contradicting what they're saying in rates, I think number one, we've got higher growth expectations, the economy expected to stay stronger, but also higher inflation expectations. So that's what you see in this chart here. We've got the June expectation in blue and the September expectation, which we just heard yesterday, in magenta. I know that's one of the favorite words on this show. And you can see unemployment rate expected to move lower in 2026 now, growth expected to move higher in 2026, and inflation expected to move higher in 2026. So if the market is reacting to, okay, we're going to have a stronger economy, yields rise, that would be the bullish way to look at it. The market may also be reacting to, the Fed still thinks that inflation might be an issue. They're not going to give us as many cuts as we thought. So this is a little bit more hawkish, at least bearish for bonds. So yields rise on that. Where the relationship problem is that yields are up today, which should actually pressure long duration stocks, right? We talk about this a lot, that discount rate rising. So if yields are going to fall, usually you see things like tech and those growthier names rise. We've got a relationship problem today. We've got both the 2-year and the 10-year up, and the NASDAQ is up more than the S&P and more than the Dow.
Yeah, and you use the term confusion. When you think about this, Fed Chair Powell did say something about GDP growth. It's about 1.5%. He said it could be higher than that. I think it's important to note that last year, GDP growth was 2.8%. Okay. So they're focused on the unemployment rate, right? And so last year, I think it was about 4% at this time. Right now, it's what? 4.3%, right? So we have GDP, then we have unemployment, and now let's look at CPI, right? And so when you think about CPI, here we are around what, 2.9% or something like that. Last year at this time, it might have been 3.2, 3.3. So none of the things that you would think about for the economy are really going in the right direction, because I could look at GDP and I could say, and Powell got a lot of questions about AI spending, CapEx, and that sort of thing. You could make the argument, if there are not other legs, okay, of the economy or other parts of the economy, they're going to start participating, because sooner or later, I suspect that CapEx is going to slow down, right? A consumer, where we saw this retail sales data, you say, oh, the consumer is fine. We're also talking about delinquencies in autos. We're talking about FICO scores going down. The consumer is a little bit strapped here. So we know that's all going to happen. So at some point, it could line up that rates are going higher, the dollar's going lower, growth is flat or going lower, inflation's going higher, and unemployment's going higher. None of that lines up particularly well. And to have the ones that will be a tailwind for the economy all going in the right direction also don't seem that optimistic, which brings me to the point, and let's pull up the S&P 500, because you just talked about long duration stocks. Those long duration stocks have been driving the performance of the market. They've been driving the pace of EPS growth, right? Guy, let's look at this intraday chart. I think about all of this and I say, is this as good as it gets for the stock market at the valuation that it is? Because when you think about the potential disconnect right here with what's going on in the economy and what's going on in the stock market, I'm hard pressed to think of a time when it's been this wide of of a spread between what's going on in the economy, likely to go on in the economy, and where the stock market is.
Yep, I agree with that. And not that I'm one to make these proclamations or market prognostications, like bold statements, but I'll say that today's going to be one of these fascinating days. So obviously made a new all-time high today. Seemingly giving a little bit back. Yesterday's low, I think, Dan, you have it in front of you, was 65.51, I believe. And we touched that briefly, and I think in the hour or so after the press conference in the Fed. Then we obviously closed, rallied unchanged. So you want to watch today extraordinarily carefully, because if you see one of these reversals, and if we were to close below yesterday's low, which, by the way, is not out of the realm of possibility given what we've seen, then we're going to start to talk about these engulfing patterns that we've seen before in individual names and potentially could be seeing today. So I'm just going to throw that out there at 11:15. I'm also going to throw this out there because we have a question about it, and Doug Cass is commenting about it. Some of these home building stocks, you would think they'd be reacting more favorably to this rate cut, and they're doing anything but. So if Amanda or one of the crack staff back in wherever Amanda lives, one of the Carolinas, I guess, you will notice that go back to last year, this time last year, a name like DH, let's do an individual name, DHI, Dr. Horton Hears a Who. That stock rallied all of the last summer into September. When did it stop, Dan Nathan? Well, oddly enough, it stopped right as the Fed started cutting rates, and then it started to cascade lower. What have we seen since the spring of this year? These stocks rallying. Where did we just see? A rate cut. What are we potentially setting up for? An absolute replay of last year where the market front runs the rate cut, takes these stocks higher, and then sells them off in the aftermath. And I think watching the home builders here, Dan, is going to be very, very important going forward.
Yeah.
What is the sell-off about, though? So why do you think that happened? Is it just?
Well, I'll tell you. So I'll answer real quick. So I think part of the problem is nobody's focused on this existing new home inventory. I think it's almost at 11 and a half months. Historically, we're somewhere around 6.5. So there's just been inventory build that nobody's talking about. But the critical factor most people think are interest rates. I don't think it is. I think it's the employment picture, which I don't think is nearly as robust as people want to make it out to. So if the unemployment rate starts to tick up in a meaningful way, I think that's going to override any tailwind that lower rates are going to provide. And I think that's why the home builders go lower, my opinion.
It's also worth noting JP Morgan's down in the day, Wells Fargo's down in the day, Bank of America's up a little bit, so they're underperforming. The S&P 500, Citibank is up a little bit. The KRE up 1%. We talked about regional banks yesterday. Liz, do you want to comment on banks and what this might mean if you were talking about the potential for net interest margins, right? Mm-hmm. Like being, a tailwind for the banks. What is the 10-year going in the direction that most folks thought it should not go in, which is what Guy said. The exact low in the 10-year yield was 1 year ago. I think this is what you're kind of hinting at, Guy, on the date that they did the 50 basis point jumbo cut. So if we were to have a
355, I think it was ish.
Yeah. So thoughts on banks here, Liz?
Well, so I want to clarify though. You're saying the 10-year yield is moving in the way that people don't want it to move?
Correct.
Who are these people? Which people?
Well, I mean, I think they think that, the White House in particular. Exactly. I mean, that's something that they were targeting, right? For the better part of the last 6 months.
Right. So when we're looking at a longer term chart like we are here of the 10-year yield, you could say that for 2025, it's moving lower, generally speaking. But the reaction to the rate cut is not what people expected. And the reaction to the tariff situation in April was not what the government expected. So when we think about bank stocks, the net interest margin, just to remind everybody, we're talking about the money that a bank can make on revenue minus costs. And just very simple, banks make revenue when they lend money. The cost is when they borrow money, or at least have to pay interest on deposits. So as the yield curve steepens, banks lend on the long end, borrow on the short end. If it steepens and they're making more money on the long end and paying less money on the short end, that should increase net interest margin, otherwise known as NIM. So what we have right now is a curve that is not steepening as much. We've got it moving up basically in what would be considered a parallel shift, right? A parallel shift up. Now it's not exactly parallel, but it's parallel-ish. What you would have maybe expected is that the 2-year yield would move down more. The 10-year yield, because they are saying that inflation is going to rise, would move up. Mm-hmm. That would be good for banks. And I think that is good for banks. And I think that banks can still do okay in this environment. I think that they've been a beneficiary of investors rotating or taking some gains in tech and still looking for other places to put it in a cyclical environment. I think, though, the regulatory picture has also benefited banks. So the fact that the yield curve is not steepening the way that people expected could, however, be less of a tailwind for banks than everybody thought. And we actually talked about this yesterday. I was on a CNBC program yesterday, and we talked about some things at the break. What do we think is going to do better by the end of the year, between now and the end of the year, the Mag 7 or the Fin 5? Mm-hmm. And we were split 50-50, Fin 5 versus Mag 7. So it'll be interesting to see how that turns out. I was on the bank side. I was on the Fin 5 side.
Guy, which side would you, if you were on that program, which side would you have been on? All right, let's go to.
By the way, it was a Robert O'Brien novel, I believe, for you fans watching at home. Mrs. Brimsby. Elizabeth, do you know who Mrs. Brimsby was?
No. I know somebody who will email us or text us.
Well, I mean, it's The Secret of NIM was a children's book. Robert O'Brien. I think they made it a film in 1982, and Mrs. Brimsby was one of the protagonists. Anyway, back to you.
Nice. So Liz is talking about the Fin5 versus the
NIMH, by the way. Not
so
NIM.
it's interesting to note here. So Apple's down in the day, all underperforming the NASDAQ, which is up 1.2%. Microsoft underperforming, Amazon underperforming, Google underperforming, Avago that comes out, Broadcom underperforming, Tesla underperforming. So you have Meta up. They just released some crappy glasses, and you have NVIDIA up because they made a $5 billion investment. I don't know why NVIDIA's up on a $5 billion investment in Intel, but they're up 3.5%. Intel is up nearly 28%. So Guy, government takes a 10% stake.
Right.
At that point, you on Fast Money said that night that we're sorry guys, the night that we were breaking it down, you said it's going to fill in that gap eventually. You see that earnings gap. We couldn't get out of its own way, for the last, I want to call it 6 to 9 months or something like that. In one fell swoop, you're back at this kind of $32 level.
Yep.
My question to you, forget fundamentals. At this point, that doesn't matter. That was a target for you. From a fundamental standpoint, I think the idea of what NVIDIA is doing for Intel makes perfect sense. You see the press calling it a lifeline. I don't think the company was going out of business. You know what I mean? I think the government put basically a stop gap in there. So here's the thing, 28% rise in the stock. Why? At some point, for them to kind of make so they're talking about making super GPU, CPU chips. Okay. That's going to be the thing that's going to power the next leg of AI. And listen, that makes perfect sense. If you go back 20 years, you ready for this? ATYT. This was a company that AMD bought. And the whole idea, ATYT was NVIDIA's biggest competitor in GPUs. At the time, the GPUs were only really used for gaming. AMD, which made CPUs, huge competitor to Intel, but at the time they were tiny. AMD, okay? They buy ATYT. They had this vision 20 years ago. I don't know if Lisa Su was the CEO back then. So it's interesting now that, let's be frank, NVIDIA, Jensen Huang, he wants to be able to sell his GPUs into China. For him to do that, that is at the center of this, trade, war that we have for all intents and purposes with China. That the White House has taken a vig for all chips by GPU or by NVIDIA sold into China. The Chinese are saying to their companies, don't buy NVIDIA's chips. Huawei is coming out saying we're making chips as good as NVIDIA's. Then the president says or one of his advisors to Jensen Huang, go take a stake in Intel because we already took a stake in there. I mean, kind of confusing. I would say clear as mud, Guy. What do you do here with NVIDIA, and why the hell or what do you do with Intel, and why the hell is NVIDIA?
Well, I don't know why NVIDIA's up. I think my instinct suggests Jensen probably got a tap on the shoulder and say, hey, you might want to think about doing something with Intel. We did it. It's going to be in your best interest. I mean, that's how this whole thing is playing out. By the way, Jensen was at that state dinner yesterday in England, for what it's worth. I mean, he was one of the invitees. But if Amanda can go all the way back to the spring of 2021, and we'll play a little stock market here, when NVIDIA made at that point a high of about 6. Is that it? No, in Intel. I apologize. I want to go to Intel. When Intel made a high for that period of time, draw that trend line down from that April high. Draw the next point is that 2020, late 23, right? And so you can ask me where it's going. That's probably where it's headed. So what does that look like on a chart? Time decay probably gets you to about 37.5, 38. We're right at that 200-day moving average now, so we probably stall. But I think we're headed to the third point of a downtrend line that's been pretty steep for a pretty long period of time. And, it's not that Intel is fixed. I don't think it's fixed at all. I mean, they have problems, but I think the stock market is trying to get ahead of what they think is an inevitability here, that they're going to sort of figure things out. That's just my quick take.
Yeah, just before we get to Liz on just semis versus software in general, because I think it's worth talking about here, because obviously there's a handful of semis that are driving the train here. A trade that I just put on, if you go and look at tomorrow expiration, okay, the 30 strike in Intel, you're looking at a bid of, where are we right here? About 40 cents. Okay, so that's, a little more than 1% if you can do that math. So I sold the 30 put that expires tomorrow at about 40 cents, and then I bought the October. So I'm buying a put calendar here, and I bought the October for about $1.40. So it costs me $1. So tomorrow, I suspect that Intel will be above 30. That put that I sold is going to expire worthless, and then I end up owning the October 30 put. And just my play, I did this in Oracle after these big gaps. You're taking advantage of this kind of spike in volatility on a short-term basis, and you're setting up. In my situation here, I'm setting up for some portion of a gap fill, and Oracle is already working out. I suspect this Intel was, because I don't know a lot of tech investors, especially after a move from 20 to 30, look at a name like Intel and can say near term, there's going to be some benefit from this partnership, from this investment. $5 billion is a rounding error for NVIDIA. So the idea that you're going to get sucked in, it's not too different than Oracle. The idea of this backlog that they're talking about over the next 5 years that immediately was kind of valued into their current market cap. I think when cooler heads prevail, folks are going to look at these things and say, you know what, that doesn't make a whole heck of a lot of sense. But Liz, we have a chart of the SOX, the SOXX.
Wait, hold on. I have a question about your option strategy.
Yeah, sure.
So I think it was the great Art Cashin, the great late Art Cashin, who said something like all gaps eventually fill. I forget what his exact quote was.
The current great guy, Adami, well, Carter does too. Yeah. But.
So then why not buy a put that's more out of the money? If you think
because what I'm doing right now is so let's just say tomorrow, okay, at 4 o'clock, let's say the stock is at 31, that 30 put that expires tomorrow, it's worthless, right? And then I end up owning the October, which is 1 month out. Okay. So your point is that's kind of short dated. If it starts going in the direction that I want it to, I can always roll it down and out, meaning go to a different strike. I can go to the 29 or something like that, or I can just roll the 30 or whatever. It just gives me a lot of optionality. And you could say, well, Dan, what if we get a down 4% move or 5% move tomorrow? And we could. A lot of times you'll see. Here's a good example. So what was a stock that had a huge gap yesterday that's trading down a little bit? I saw it. What was a big gap stock? I don't know what, but it's basically down a few percent after a big gap. I mean, at some point you get shorts covering on the day of the news and this and that, whatever, so is what it is. Oh, Lyft was that example. So Lyft is down a couple percent after a huge gap like that. So into expiration makes some sense. Let's pull up the SOX chart, SOXX. Why we like this over the SMH? Because the SMH, the two largest holdings, Taiwan Semi, NVIDIA, and if they're up a lot, the SMH is going to be up a lot. This is more of an equal weight. Liz, you see that it's gotten right back to those prior highs from last year. It's had a heck of a run. We know this is more equal weight. When you look at this, now let's pull up the IGV. And the IGV obviously very heavily weighted towards Microsoft and Oracle. I think Oracle is the number one.
Now it is.
Yeah. So let's talk about that a little bit, like what you're seeing between the two of these.
Yeah. Can we put them on the same chart while I talk here a little bit?
Man,
so I have been making a call for software for a while. Last year, I looked smart. This year, I look less smart. Well, it's trailed. It hasn't been negative, but it's trailed semiconductors. And that's been the call for me, is that I think software will do better than semiconductors. The long-term thesis being that software is the conduit, or at least the agent, where companies can actually put AI into work and create profits from it. I still think that has to be the case. I still think software companies can benefit from that. It's just that we made this transition. If everybody remembers, earlier this year, investors, and even for the first half of this year, investors were punishing companies for spending too much. We got sort of sick of the spending and said, well, show me the money now, show me the profits. And that's when software, I thought, was going to pick up. So what's happening now, and it's done well over the last month or so. What's happening now is, I think semiconductors, as you showed in that chart, back up to where they were before a lot of this volatility occurred since April. I don't know how much further they're going to go from there, at least not in an equal weighted ETF, right? The one that is market cap weighted, driven by headline companies, maybe could go further, but I don't know how much further they can go from here. So actually, I would say that this is a good time for software to start to take the lead again. And anybody who's trying to make some sort of play in technology, which this has become a conversation lately, buying defensive technology rather than semiconductors or those big headline makers, software is generally looked at as a more defensive component of technology.
All right, Guy, really quickly though, you say that, I was going to say Amanda, Liz, but Oracle is the number one holding at 12% in the IGV. Palantir is the next one at 10%. Microsoft at 8.5% can't get out of its own way. Salesforce at 7% can't get out of its own way. I don't even know where Intuit is. So I look at the IGV and you could say, well, this is the reason why we're not using the SMH, right? I look at Oracle, Palantir. I don't particularly think, there's risk there to those two.
Yeah.
Microsoft is kind of stuck in the mud. Workday just saw a activist. Elliott took a stake. Stock had a big run. But some of these stocks are really not performing.
No, they're not. That's why you have to. That's why I hear what Liz is saying. But if you want to get granular, I'd go down to Salesforce, and we've actually talked about this. That 230-ish level was the low in early August. If you go back to sort of April, like everything else, that was sort of the low in mid-April as well. We have basically defended that. It has not bounced in a meaningful way. But, you get this thing above 250, and I'm talking about Salesforce, and you might start to get a little giddy up here. You can actually see the trend line from that high that we saw in May when I think the stock was close to 300. And you'd want to draw that downtrend line over a short period of time. You could see those little double bottoms. That's why I think there's a chance that Salesforce, look, right now it's right at this trend line. But I do think there's a chance we take that out. And then maybe we get up to the 200-day moving average, which, by the way, is still sloping lower. So that's how I'm looking at sort of the software side of things. I'd avoid the ETF. I'd go to this name specifically.
Well, look at Adobe too. It's got a similar sort of format. Both these stocks have, reported in the last few weeks. They both had moves lower, and they filled in those gaps. And now maybe they're just looking a bit more constructive. And I think, Guy, what you're talking about as far as targets, whether it's that prior high that they made, let's say, 3-4 months ago, and you see those downward sloping 200-day moving average, that could make another one that actually has a gap to fill. This is Figma, right? This is a name that is a competitor to Adobe, and not a great quarter whatsoever. The first quarter out of the gate since their IPO. But that one could be a little bit squeezy. And that one probably is also facing, there's probably a lot of initiations coming out by a bunch of banks. So that might be an interesting one to think about. So, and the last thing I just wanted to kind of bring up that Oracle chart for a second. Because it looks like this one's going to be pinned to 300 on expiration tomorrow, Guy. It really feels like it wants to fill in a part of that gap. So, to your point, you might see money come out of some of the names that have performed very well in software and move into some of those laggards. So just for whatever that's worth. So,
stay tuned.
Stay tuned.
We have a question from Jack CF. Anytime I hear F in like a name, I'm assuming that it's somewhat derogatory, but who knows? I mean, maybe it's.
Hold on, you got to stop here. Maybe they can find the clip from the sequel to Ted. They're in there. It's Marky Mark and the Funky Bunch, and with the little doll. You know what I mean? And they're talking to I think it's Amanda Seyfried or something, or Seyfried or whatever is the actress, and she's like, "You guys have never read Great Gatsby by F. Scott Fitzgerald?" And they're like, "Why are you saying F?" Scott Fitzgerald, what did he ever do to you? And they have you ever seen this? It's so funny. So
that's what we've been conditioned.
And we'll put that in the show notes, people.
Put that in the show notes, please.
Safe for work,
Jack CF, no relation to F. Scott Fitzgerald, is asking about the IWM, which I believe today has made a 52-week high. I also believe we're hauntingly close to the prior all-time high that we saw in November of 2021. So it's make or break time here, Elizabeth. And again, I don't want you to play. Here's my question. Is this environment conducive to staying long or initiating a long in the small caps, in your opinion?
As a trade, I think it is. I don't think that this is a time when you buy it because you think small caps are going to durably outperform large caps. And here's why. So when we look at just Fed cutting cycles, first of all, small caps are right now in the midst of what I would consider a catch-up trade, not a big outperformance trade. So I think they're catching up to large caps over the last few years. And looking at that chart, it's really not all that impressive. They're just now getting back to some highs that they've sniffed before. It's not like that chart is going from the lower left to the upper right in a definitive way. Because rates are being lowered and because we expect more rate cuts to come, this is the product of the broadening out trade. Broadening out trade is going to reach down in the cap spectrum. It's going to reach across into other sectors besides communications and technology. And that is everything that has happened. This is a lot of it being a rate cut rally. Small caps do really, really well when the Fed is cutting rates, but deeper into the cycle. So beyond 200 basis points of cuts. Why is that? Because by the time the Fed is cutting by 200 or more basis points, it's probably because we're in a recession. Small caps outperform on the other side of a recession almost every time. The financial crisis being one exception to that, where mid caps actually outperformed because that's where most of the financials sat at the time. But small caps would be likely to outperform on the other side of a recession. Right now, this is what we would call an adjustment cutting cycle. The Fed is cutting to try to normalize rates, not to save the economy. In those scenarios, there aren't many, but in those scenarios, large caps actually outperform small caps when you look 6 months, 12 months, 18, more like 18 months out, 12 to 18 months out. So is this a spot where you can buy small caps betting on them catching up for the remainder of the year? Sure, but then realize that you're going to have a short-term gain, not a long-term gain to deal with tax-wise.
Look at that. And that's a cogent answer.
I mean, she just killed that.
Now, just so people know, what do they call it when you get behind like the fourth wall or something?
You break the fourth wall.
So you'll notice every once in a while I'll look to my right, and that's because I'm looking for questions. And sometimes Jacob or somebody, or Amanda or Timmy or Bill or Cece. In this case, you're going back and forth with the great Bill Hochman. Bill, where are you performing tonight, by the way, for folks that are interested?
I'm not performing tonight. Sorry, guys.
Not performing. No, Thursday night in the fall in September.
Usually at the Greenwich Comedy Club, to be honest with you, on Thursday nights.
Oh, I mean, that in of itself a problem.
No, 7:30 on Thursdays, 9:30 on Tuesdays, and oftentimes, he was in. He played in Atlantic City a couple weeks ago, Saturday night. Yeah, he's big time. He's blowing up.
Performing.
Yeah, Billy Hochman. He's at Billy Hochman on the Instagram. Go follow him. He and one of his buddies, they're doing a lot of good work, sometimes in this very seat. So at Billy Hochman, check him out.
I'm going to break the fifth wall real quick because I have people telling me that I'm slouching. Actually, I'm looking at Linda Snow right now. She's like, sit up straight.
She's telling you. She's telling you that you're slouching, by the way. One thing before I know we got to get out of here. ETF, it's called Hack, HACK. Okay. And Liz, this is, if they can pull this up, maybe this is kind of what you're referring to some degree as more defensive software, right? Because this is the security infrastructure a little bit. We're seeing CrowdStrike up 10%. They just raised some guidance at an analyst day today. That looks like a constructive chart. And the one thing I'd say about this one is that because the valuations are really high in these names, I know, Guy, you've been high on these names, not like that high, but just you've been very positive because Guy has never actually.
No, I have not. No, and I know people don't believe
never
this.
Puffed the magic dragon.
I never puffed the magic dragon.
Yeah.
Okay, so there's two things I want to make a point here. There's a difference between defensive tech and defense tech. So when there are companies, Palantir would be one of them, companies that are in the defense space in technology. The play could be actually both of those. Defensive tech, to your point, yes. Cybersecurity,
well, that's what I
absolutely.
think you're thinking.
Yes. And so when you look at just broadly software versus semiconductors, software is seen as more defensive because it's got stickier revenue streams. People are under contract, that sort of thing. Defense tech is another thing that is coming into the forefront right now. A lot of those companies, aside from Palantir, are not U.S. domiciled. There's European defense companies have done really well.
A lot of private stuff too. Exactly. That Anduril is doing really well.
That is an option as well. But when we're talking about defensive tech, yes, cybersecurity would be in that camp. Now, the cyber stocks, some of the cyber stocks have seen like wild swings and are probably way overvalued when you look at them on a when you look at them on a price to sales multiple. So that is definitely occurring. So be careful there with the entry point. But I still think cybersecurity as a long-term investment is a good place to be. I think that we can all agree the world is going to need more cybersecurity as time goes on. So this is a space where I think the demand just continues to stay. Yes, Guy, your turn.
Thank you, Elizabeth. Because I have the memory of an elephant. It was about a year or so ago that you and Mario came to you and said, I have this idea about European defense stocks.
He did.
And you said, that's really interesting. And I will tell you that his idea, and see, like friggin' steel trap.
Steel trap.
And those stocks have done extraordinarily well because they were forced to spend in ways. Germany, for example, was spending in ways they hadn't spent in 80 years. And Mario was well ahead of that. Back to you.
He was well ahead of it. And I said, that's an interesting idea. How do we invest in them? Right. I was considering, like, should I use that as a trade? And he was like, you know what? There's not actually a good way to do it in a diversified way to access it. And that's still the case. Yeah.
One thing I just say about defensive, software, if you think about all of these in a downturn, in the economy, or you have some sort of compression as far as different secular trends, I mean, you're much less likely, to your point, to cut security, license than you are, let's say, if you've been trying out Copilots from Microsoft. And, I'll put this in the show notes. I don't know if you can access it from the information. I think this came out 2 days ago. The article was Salesforce, Microsoft finds selling AI to enterprises is easier said than done. And this is something that we've seen of the McKinsey report, and the list goes on and on of things talking about the uptake of these AI tools. Doug Katz has been talking on the streetpro.com. So I just think that is an interesting thing. You're more likely to see what's going on here. You're more likely to see, budgets, supported in this security.
I don't know what that was.
I don't know this sound. I don't know what it does.
I don't know what's happening over there, but I would argue that companies will actually cut their workforce before they'd cut cybersecurity.
Yeah. I mean, in this environment, if you are getting internal benefits, like the article that I just said, their ability to sell this to enterprise, you know what I mean? So if Salesforce was talking about the agentic AI that they meant to sell to monetize their investments, this is when they reported 2 weeks ago, they were talking about they're getting better productivity internally using these tools rather than externally selling them. Guy,
hold on real quick. Can I just put a bow on this cybersecurity? Sure. So if we put up a Palo Alto Networks, that comes out, Dan, PANW. Yeah. Of course, I think Elizabeth knows the great Luis Yamada. And if you go longer term, please, and you'll see what I'm looking at. Look at these. Look at how long we've just been sort of floating around these highs. And what Louise will say is the greater in space, the higher in outer space, something like that. So the fact that we've been bouncing up against these prior highs now for the better part of 8 or 9 months, to me, suggests that we're going to continue to go higher. By the way, the Spinal Tap 2 is coming out, I believe, in a couple of weeks. That is must watch for the entire risk reversal community.
I think you will be disappointed, Guy. That is my take. It's gonna be like your Godfather 3. I'm just telling you. I'm going.
No.
All right. I know I just triggered you with Godfather 3. Really quickly, before we get out of here, we gotta tease Liz. The important part.
Oh,
that would be her podcast. It could be second season or third season.
Fourth.
All right, fourth season. Go to your podcast store. Follow it, search for it, follow it. She's got a great slate of folks that are going to be coming on. And then if you like her and Mario's work, and you just talked a little bit, Guy, about your steel trap, you know what I mean? Like, you remember the European defense tech, if you want all of that and you want that report in your inbox, go to SoFi.com/on-the-money. Oh God, I need to.
You can just go to the website.
Oh geez. If you want that, then you can have it in your inbox. Guy, what is that URL again? Just if you want that report in your inbox, where should you go?
SoFi.com/on-the-money. It's a mouthful, but you know what? It's worth it. It's like a Whopper with cheese. It's a mouthful, but it's worth it.
At Liz Thomas Strat on Twitter. You can also get it. Okay, yeah. Liz.
And the
by the way,
watching the fourth season. So first episode will be out first half of October. So
nice.
you follow it now so that comes straight to you.
Yeah.
Dan, whilst you were in California on a work trip, I want to emphasize Elizabeth and I waxed poetic about the state of sports in the great state of Wisconsin. Nothing's changed since then, by the way.
and the Packers.
Brewers and the
Sure.
Packers.
Did that like being waxed, guy? I mean, like,
I mean,
you know what I mean? Like, you waxed what? What did you wax?
A waxed poetic.
Oh, I thought you waxed a poet. I was
No,
just.
I wouldn't whack or wax.
That would be. I thought that would.
Some poets need to be waxed. If you look, a lot of poets throughout history have had beards and.
Oh, I thought you were talking about Godfather 3, like whacking a poet. You know what I'm saying?
No,
like, is that your favorite Godfather?
There's no such. First of all, there's no such thing as them. I mean, people.
No, I was on. Like I said, you said I was in LA the other day, so I was on a plane and I'm getting all set up with my iPad. You know, it's like a flight. You know, and this guy next to me or across the aisle, I did not expect this. I looked him up and down. I did not expect this. He hits the buttons, you know, on the screen and this and that, or whatever, and he pulls up Godfather 2. And I'm like. And I wanted to be like, my man, you know what I mean? Like, you know what I mean, guy? And, you know, guy, you would never watch Godfather 2 on a plane because when you're on a plane, you do what?
I think about it.
Oh, what do you do?
Well, I raw dog. I sit there and I just stare.
That's what he said. Like, he read that.
No, it's a thing. I'm not making this shit up. Can I tell you something? But I know sorry, Amanda. By the way, Amanda is doing great.
Yeah.
About 6 months ago, I'm reading the New York Post and I'm reading this article and I'm like, raw dogging? I mean, you got to be effing kidding me. I've been doing this for 30 years.
That your first answer to that was, I'm thinking about it. Did you hear that? I'm thinking about Godfather 2.
Yeah, no, I don't know who wrote that article in the New York Post.
It was wrong. You think it was
wrong.
It's not the thing that you think it is.
Urban Dictionary.
Freak people out. I don't. I mean, again, I don't need. We need to go through this. Well, you've flown with me. Elizabeth is not. She has not had the honor of flying, but you'll see. I get in my. Put your ass in the chair. You don't. What do you got to get up for? Explain it to me.
He just said wrap it. He said wrap it.
Said wrap it.
Yeah, and Guy, we found that.
We found the story. What could kill you? Experts warn. Tell Bill to stop. It could kill you.
Show of hands, Guy. All right, Liz, we really appreciate you being here. I know that you're probably sick of us by this point. It's twice this week.
Just now you think I got sick of you guys?
Oh, man.
I'm coming in. We're going to have a conversation in about 2 hours.
You know what we have on the pod later today? Guy and I, she used to be on CNBC a bit. She's now the head economist at MasterCard. I think she's been there. Michelle Meyer.
Okay.
She might be a good guest for the important part.
Okay.
Yeah.
I'll look her up.
Yeah.
Hi,
Michelle Meyer. Okay. Oh my God. What are they doing? Something's waxing something on that.
I think we're going to wrap it.
Yeah.
Yeah. I'm going to wrap your show for you.
All right, Liz.
Thanks everybody
so
for joining us today.
Yes, she's sick of us. All right. Bye-bye.